Now, the financial year 2021 had witnessed a record highway construction and abating activity, with road sector stocks rising between 80 to 180%. With an average of a record of 37 kilometers per day of highway construction, 13,327 kilometers of highways were constructed in FY 2021 as compared to 10,237 in FY 2020. The performance was better than the benchmark indices such as Nifty and Sensex, which rose about 75%. While the initial part of the year was impacted by COVID-19 lockdown, the execution picked up significantly from Q2 and Q3 of FY21 after a steep drop in COVID-19 cases, the government's unlocking measures and return of the migrant labour. Moreover, increased allocation in the union budget towards road construction also led to a robust outlook for the sector, resulting in an outperformance by road sector companies. The banking credit to the sector improved, highway construction and abating activities reached record highs, leading to a re-rating of the sector. But it might be a deja vu once again as a second wave looks to unravel what had been achieved post the second quarter. There's a chance that the government's ordering activity is also likely to taper off, while the funding for the sector might also get curtailed in the near future, as the economic recovery might witness a pause button. But with improved pace of vaccination, the execution is likely to pick up once the COVID-19 cases recede. As of now, order book for the companies remains strong and the government has planned huge investments for the long term. So what really has been the impact of the second wave? Daily infections have reached 2.6 lakhs per day compared to the peak of 1 lakh cases the first wave saw in September 2020, with Maharashtra, Delhi, Gujarat, Rajasthan, Karnataka and Odisha having announced significant restrictions. As in the case of the first COVID-19 wave in May to September 2020 period, construction labourers might migrate back to their villages, which would impact the execution of projects by the companies. Revenues of construction companies have also fallen about 30 to 35% in the first half of FY21. owing to lockdown and non-availability of labour. Further localized lockdowns and restrictions can hamper availability of raw materials and equipment, which can impact the project execution. For road construction players as well as government, given the delayed execution, construction companies may not be in a position to do more orders. Given the restriction on movements, toll collections are also likely to be impacted, which would affect revenues. If the government payment tenure in the second wave and if payments are delayed, then it would increase the working capital and consequently leverage on the balance sheet. With increased execution risks and likely increased working capital requirements, the balance sheet may get stretched and thus lending to infrastructure companies might get curtailed. If you talk about the near-time blip, is a long-term prospect really bright? Despite the challenges being faced, order book of the companies are robust, with the government's clear focus on strengthening infrastructure and huge investments under the National Infrastructure Pipeline. The long-term outlook is positive. In terms of stocks to pick up, KNR, PNC and HG Infra have comparatively low debt and equity and are adequately capitalized. Hence, the delayed execution and expected lower funding is also likely to have relatively lower impact on these companies. Also, these companies have proven execution capabilities, indicating a faster revival once the COVID-19 cases subside. These stocks should be ordered on declines.